subsidiaries. So from company law, I hope you can be able to remember what is a parent company or what is a holding company, and basically what is a subsidiary. A holding company or basically a parent company, is a company which has acquired the majority of the shares or basically more than 50% of the shares issued by another company. So the company which has acquired the majority of the shares is known as the parent or the holding company, whereas now the other company is known as the subsidiary company. So like assuming in this case we have a company A, and you're told that this company has acquired more than 50% of the ordinary shares, basically which are issued by company B. So in this case, this company here is known as the parent company. In other terms, this can also be known as the holding company, whereas this company here is known as the subsidiary company. So now, this company, which is called the parent company, at the end of each year, is basically expected to prepare the group account or the consolidated financial statement. And we are saying that these group accounts are prepared by this company by combining similar items, of what? Of assets, liabilities, revenue and expenses, those of the parent company and those of who? Of the subsidiary. And in this case, it is very, very important for you to understand that these group accounts are not prepared by any other company, but purely they are prepared by the parent. So it is not the subsidiary company to prepare the group account, but the group account should be prepared by who? The parent company. So therefore, as far as this topic is concerned, we're going to look on how we prepare the group account. And also, in this case, we're going to discuss in detail some of the accounting standards, which basically governs the preparation of this particular group account. But even before we proceed to do that, to look on those specific standards, to look on how we prepare the group account. First of all, I want us to maybe look on the definition of various terms. So these are some of the important terms we need to understand even before you proceed to prepare the group account. The first term here is basically called, or the first term is group. And in this case, when we talk about the group, basically this refers to the parent company and its subsidiaries. The parent company and its subsidiary company. So meaning that if, for example, we have this company and this company has one subsidiary, or maybe this company has two subsidiaries, then we refer to this as a group of companies. So the parent company and its subsidiaries are known as a group of what? Of companies. So in this case, we have said whenever you have a group of companies, then you have said that this company here, that is the parent company or the holding company, is the one which has an obligation to prepare the group account or to prepare the consolidated financial statement. So the other term we can also define here is the parent. So this company, the parent company, controls another company which is known as the subsidiary. Basically, control is determined in terms of checking the percentage shareholding. So if this company here has acquired majority of the shares, more than 50%, we say that this company controls the other. Though this control is not, or basically the control does not exist, whereby a parent company has acquired majority of the shares. Generally, we say this company controls this one. Number one, if the parent company controls the composition of the board of directors. What does that mean? It means that if this company here, company A, appoint majority of the directors in company B, so then in this case, we say that this company here controls the composition of the board of directors of company B. Number two, this company will also be deemed to be controlling this one if this company here basically do what? It controls, we can just put that there, it controls the operating. Yes, so welcome to our financial decision, and I want us to start on this financial decision new topic. And actually, this is the statement of the cash flows. So in this operating and financial decisions, we're going to define what is a statement of cash flows, and also we look on how do we prepare this company, or how do companies present a statement of cash flow. So a statement of cash flows, number one, this is one of the components of the financial statements prepared by companies at the end of the year, And a cash flow basically is prepared to show the sources of cash and the application of that cash. How did the company generated cash? And actually, how was that particular cash utilized, or basically how that cash was spent? Now, a statement of cash flows basically should be prepared in accordance with this standard IS 7, International Accounting Standard number 7. And this particular standard requires that when the company or when companies are preparing a statement of cash flows, the various activities undertaken by such a company or by such companies should be classified into three categories. So, mean that for the purpose of preparing the statement of cash flows, then we classify the activities of a company into three. Number one, we have the operating activities. Number two, we have the investing activities. And number three, we have what? We have the financing activities. First of all, what do you mean by the operating activities? Operating activities, these are the revenue generating activities undertaken by a company. Revenue generating activities undertaken by a company. Like basically here at Focus Online College, we offer some training of various custom courses. So that is our generating what? Activity. So therefore, these are the revenue generating activities undertaken by the company. They include provision of services. They include sales of goods. Investing activities are those particular activities which involve acquisition and also disposal of assets. Any activity involving acquiring and also disposing or selling assets is an investing activity. And finally, financing activities are those particular activities which by the end of the day affect the size and composition of the company's capital structure. These are activities which relate to issue of shares, issue of debt instruments like debentures, acquisition of bank loan, repayment of bank loan, and maybe redemption of things like what? Debentures. So therefore, when preparing a statement of cash flows, basically we classify the activities into those three categories. And then from there, we must compute something called the net cash flows from each of these three activities. We must determine the net cash flows from operating, investing, and financing. How do we determine these net cash flows? Net cash flows from these three activities. We take the cash inflows, and basically cash inflows, this refers to any cash which is coming into the business, any cash received by the business. And the rule is that when preparing the statement of cash flows, any amount which is a cash inflow, we record it as a positive. Any amount which is a cash inflow, we record it as what? As a positive. A good example, if the company issue share, if the company issue debentures, if the company sell an asset, all those transactions result to cash inflow. So the cash received, we record it here as a positive. And then to this, we left the cash outflows. Cash outflows, basically, this refers to any amount of cash which is flowing out of the business. So like whenever the company purchase an asset, when the company, for example, redeem shares or even debentures, that give rise to cash what? Outflow. The rule is that any amount which is a cash outflow, when recording it in the statement of cash flow, we record it as what? As a negative. This is very important. A cash inflow, record it as a positive. A cash outflow, record it as what? As a negative. So that means that at each of these activities, will be taking the cash inflows as positives and cash outflows as negatives. Then you add all those cash inflows and outflows, you get a net what? Net cash flow from each of these activities here. Now, before we look on how we prepare a statement of cash flows, it is important for us, maybe first of all, we define some few terms. Let's look on definition of various terms. Definition of various terms. These are basically terms we will come across when preparing the statement of cash flows. So the first term here is cash. What do you mean by cash? Cash, basically, this comprises of cash in hand. This also within a short period of time. Within a short period of time. A good example of this is where, for example, a company has invested in shares which are trading in the securities exchange market. That is basically what? A cash equivalent. If, for example, today, maybe you own some shares, and those shares basically trade in the securities exchange market, that is not cash to you, but basically cash equivalent. Because if you need money maybe by the end of the week, what you just do is you inform your stockbroker to sell those shares, and maybe by Thursday, Friday, you should be having money in your account. Therefore, that those shares you own and which are trading in the securities exchange market is not cash, but is a cash equivalent. It's a short-term investment which can be able to convert into known amount of cash within a short period of time. The other term we need to define here is something called the non-cash items. So non-cash items, basically, these are items of incomes and expenses, incomes or expenses, which do not involve movement of cash. They do not involve movement of cash. Items of incomes and expenses, they do not involve movement of cash. In this case, there is a certain acronym which we use here, basically to remember these or to know some of these non-cash items. The acronym is 𝐷𝐿G. 𝐷𝐿G. This stands for depreciation. We know depreciation to define. Now, how do we prepare a statement of cash flows? So presentation of a statement of cash flows. Now, here we have two methods which can be used by a company in preparing a statement of cash flows. Which are those two methods? One, we have the direct method. And number two, we have the indirect method. What is the difference between these two methods? The difference between direct and indirect method is how we determine the net cash flows from operating activities. I hope you can be able to recall what you have said. When preparing a statement of cash flows, we determine the net cash flow from operating activities, from investing activities, and from what? Financing activities. So the difference between direct and indirect method is basically how we determine this one, how we determine the net cash flow from operating activities. Basically, what that means is that to determine the net cash flow from the investing and basically financing activities, under the two methods, we use the same approach. We use the same approach. This is the only difference. How we determine the net cash flow from operating activities. So I want us to start by looking on how we compute, or basically we determine the net cash flow from operating activities using the direct method. So how do we determine, in other terms, how do we compute the net cash flow from operating activities? So under this method, to compute this one, net cash flows from operating activities, this one we computed directly from the cash book. We compute this directly from what? The cash book. I hope you can be able to recall what we record in the cash book. This is something you did in financial accounting. A cash book basically is one of the books of original entry, cash book, of which in this case, a company can either prepare 2-column or 3-column cash book. And on this side, that is basically the debit side, and that's the credit side. On this side, we record the receipt. Money received either in cash or by check. Whereas on this side, we record what? The payment. So therefore, we are saying under this method, in computing the net cash flow from operating activities, we compute that directly from what? The cash book. How do we compute that? So how do we compute the cash flows from operating activities under the direct method? So one, we take cash received from debtors or basically customers, of which this cash received from debtors or customers, this one we get it from our cash book on which side? On the debit side. And this cash received from debtors or customers, is this an inflow or outflow? This cash received from debtors, if you have a business, you have received money from your debtors or customers, what is that? Inflow or outflow? Inflow or outflow? Inflow or outflow? I'm told it is inflow. So if you then recall what you have said, any amount which is an inflow, we record it as a positive. Any amount which is outflow, we record it as what? As a negative. That being an inflow, we record it as a positive. So then we also, from our cash book, we take cash paid to creditors, to suppliers, of which the cash paid to creditors or suppliers, that is a payment. Being a payment, it should be recorded here as a negative. So then we also take cash paid for operating expenses. For operating expenses, cash paid for operating expenses, still that is a cash outflow. We get the net amount here, and then we proceed with less two items. One, we less tax paid. How much tax was paid during the current year? And basically the reason why we less tax is because tax paid is a cash outflow. These are cash outflow. That's why we are taking it here as a negative. It's a cash outflow. We also less the interest or the finance cost which was paid. The interest or the finance cost which was paid. And still is a cash outflow. Is a cash outflow. That's why we are taking it as a negative. We are taking it as a negative there. We are taking it as a negative. And then in this case, we get the net cash flows from operating activities. The net cash flows from operating activities. The net cash flow from operating activities. The net cash flow from operating. Yes, so basically this is how we determine the net cash flow from operating what? Activities. So you can see what we consider here. Cash received from debtors or customers being a cash inflow. Cash paid to creditors or suppliers is a cash outflow. Cash paid for operating expenses, a cash outflow. Then we have these two items which we consider here. Tax paid, the interest paid, those are cash outflows. That's why you can see we are considering them here as what? As negative. So then from there, how do we determine the same? How do we determine this net cash flow from operating activities? Using the other method, the indirect method. The indirect method. Indirect method. Now, under this method, we compute the net cash flow from operating activities by adjusting the operating profit with the various items, three category of items. So here, under this method here, to compute the cash flow from operating activities, we start with the operating profit. We start with the operating profit here. We start with the operating profit. Basically, the operating profit, if you can be able to recall, in the topic of ratios, we said is the same with the profit before interest and tax. But in most of the questions, the examiner will not have given you this, the profit before interest and tax. So what the examiner will have given you is the profit before tax. Basically, what you start with here, you start with the profit before tax. And for you to have this, the first adjustment which you make to this profit, the first adjustment is basically to add back interest. To add back interest. And if you can be able to recall interest, this is also known as the finance cost. So the reason why we add that back to to this profit is for us to have the profit before interest and tax, which is also known as the operating profit. Now, this operating profit, we adjust it with three categories of items. One, we adjust this with the non-cash items, items, which were added or basically deducted in arriving at that profit. So which are those non-cash items? Remember, there is a certain acronym which I've given you somewhere here, which is basically 𝐷𝐿G. 𝐷𝐿G. So 𝐷𝐿G basically I've said this stands for depreciation, I for impairment loss on goodwill, A amortization of intangible assets, L loss on disposal, G gain on disposal. So those non-cash items which were deducted in arriving at this profit, like depreciation, impairment, amortization, and loss, all those items in arriving at that profit, they were deducted. And because they are non-cash items, what we do, we add it back. But the gain on disposal is an income. In arriving at this, it was added. And because it's a non-cash item, what we do, we less it. So first of all, we adjust our profit with that. Number two, we also adjust it with the changes in working capital. Working capital here, equally there is an acronym which we use here to recall the various working capital items we consider here. And the acronym is RIP, not less in peace, but RIP, receivables, inventory, and payables. Receivables, inventory, and payables. So in this case, you just need to consider, was there an increase or a decrease? Compare the opening balance with the closing balance, see whether there was an increase or decrease. So then finally, we also adjust this particular profit here with the investing and the financing activities items which were added or deducted in arriving at this what? A profit. Good examples of these investing activities may include investment income. Investment income in arriving at this profit, or actually this profit include investment income. But we know investment income is an income generated by the company from investing. It's not an income generated by the company from operating activities, from operation. So, and because that investment income is included here, we less it. We less it. And then when computing the cash flow from investing activities, then when we consider that amount. So therefore, any investing activity, any investing or financing activity item added here, we less it. Any investing or financing activity item basically added here, we do what? We less it. And those basically which were deducted in arriving at this, we do what? We add them back. We add them back. We get the net amount here. And basically, finally, here we less the tax paid. We less the tax paid simply because it's a cash outflow. And then the interest which was paid. The interest which was paid. Basically, what we get here is the net cash flows from operating activities. The net cash flow from operating activities. Now, this is basically the difference between these two methods, how to determine the net cash flow from operating activities. But now, once we have computed this cash flow from operating activities, we must proceed and compute the cash flow from investing activities and the cash flow from financing activities. To compute those two components, the cash flow from investing, the cash flow from financing, we use the same approach under the two methods. So basically, after we have computed this, we proceed and we determine or we compute the cash flows from investing activities. Remember, in this case, you just need to recall that investing activities, these are those activities which involve acquisition of asset and disposal of asset. So here what we consider are basically the assets which were acquired by the company during the current year, and those assets which were disposed. So here we consider acquisition of assets. Acquisition of assets, basically this one involves cash outflow. If you buy an asset, that gives rise to cash outflow. We also consider the disposal of assets. Disposal is the same with the sale of assets. And then here we also consider any investment income. Any investment income received. Those are the only items which we consider here. We get the net amount, we take it to the last column, and finally we determine the cash flows from the financing activities. Financing activities, or basically all the items which we include here in computing this cash flow, we get them from equity section in the balance sheet or in the statement of financial position, and also the non-current liability section. That's where we get all the items to be included here. Go to the statement of financial position and the equity and the non-current liabilities. That's where you get the items to be included here. Yes, disposal of assets. Yes, disposal of assets, sorry, this one should be positive, because once we sell an asset, we receive money. Money received is a cash inflow. Investment income, we receive money, is a cash inflow. We buy an asset, is cash outflow, should be recorded as a negative. So what we consider here are items such as issue of shares, or maybe issue of debentures. We also consider acquisition of loans, acquisition of bank loan, acquisition of bank loan. We also consider the repayment of bank loan, the repayment of bank loan. We also consider things like the redemption of things like debentures, and also we consider payment of dividends which were paid. Now, once the company issues shares or debentures, that result to cash inflow. Once the company acquire a bank loan, that is a cash inflow. Once a company repay a bank loan, that is a cash outflow. Once the company redeems the debentures, that involve cash outflow. Once the company pay dividends, that involve cash what? Outflow. So we get the net amount, we take it to the last column. And then from there, we get something called the net changes in cash and cash equivalents. So how do we get this? So to get the net changes in cash and cash equivalent, we take this one, net cash flow from operating activities, plus this net cash flow from investing activities, and this net cash flow from financing. So we take A plus B plus what? Plus C. Whatever is a negative, you take it as a negative. Whatever is a positive, you take it as what? As a positive. And now to this particular amount here, this one, we add something called the cash and cash equivalents. We add something called the cash and cash equivalents. Cash and cash equivalents. Balance brought down. And in this case, you have to recall, what is cash? Cash comprises of cash in hard, cash at bank, and also the short-term investment, including the bank of overdraft. That's basically what we consider here. Cash in hard, cash at bank, short-term investment, including bank overdraft. Basically, we add it to this amount here, and we get something called the cash and cash equivalent balance carried down. Balance carried down. So this is basically how we present, or in other terms, this is how we prepare what is known as a statement of cash flows. A statement of cash flows. Sawa? Is that well understood? Is that well understood? How we prepare statement of cash flows? Is that well understood? So, but basically, you can only be able to understand this once we do maybe one or two illustrations. Yes. So I want us to just take a small breather of how many minutes? 5 minutes. And then as we come back, I want us to look on a question. I want us to look on a question from a past paper. And I want us to do a question for last sitting. There was a question. Actually, this is a very common area, but I want us to just start with a question which we will be able to finish within the next 1 hour. So let's start with this one. December 2022, question 5. Question 5. So as we come back after that small breather of 5 minutes, make sure you have that question with you. December 2022, question 5, a question for a company called 𝐼𝐍 Limited. 𝐼𝐍 Limited. So see you after that short break. 5 minutes only. We come back at 8:52. 8:52. Yes, we proceed. I hope you already have the question with you. The question is for December 2022. December 2022, which is question number 5. Question number 5. We should finish this particular question here, such that once we meet in our next class, we basically do another one. So we are told the following draft financial statement were extracted from the financial statement of or financial records of 𝐼𝐍 Limited, a public limited entity, as at 30th of April 2022, with the comparative for the year which ended 30th of April 2021. So in that case, we're given the statement of financial position for 2 years, 2021 and 2022. Down here we have the statement of profit or loss, another comprehensive income for the year which ended 30th of April 2022. We have additional information, number 1 all the way to note number 5. What are we required to do here? We are required to prepare the statement of cash flows for 𝐼𝐍 Limited for the year which ended 30th of April 2022 using the indirect method in accordance with the International Accounting Standard number 7 statement of cash flows. Now, before you prepare that statement of cash flows, it's always advisable, first of all, go through the additional information you see. Is there any working which is required? You do those workings, and then you prepare the statement of cash flow as required by the examiner. So I want us to go through the additional information. Basically, we see whether there are some workings we need to do. And then finally, we prepare a statement of cash flows. In additional information about you're told, 𝐼𝐍 Limited acquired a new plant, or basically purchased a new plant during the year which ended 30th of April 2022 at a cost of 1.8 million from a finance company. An arrangement was made at the date of acquisition for the liability. Once a company buys an asset, the company has an obligation to pay for that asset. That obligation to pay the liability. So we are told an arrangement was made that at the date of acquisition for the liability for the plant to be settled by our company 𝐼𝐍 Limited by issuing 10% loan note dated 2025 to the finance company. So the company will not pay for this plant in cash, but the company will issue loan notes. Loan notes, these are debt instruments having some value. So the finance company will be issued with loan notes free of charge. So then we are told the value by which the loan notes exceeded the liability of the plant was received from the finance company in cash. Now, in this case, what we need to do, basically, we know loan notes. Once a company issues loan notes are the same with the debentures. So these ones are accounted for by the company, the balance sheet, in the statement of financial position as a non-current liability. So can we go to the non-current, to our statement of financial position we have at the paragraph 1, specifically where we have non-current liabilities. So can you see the non-current liabilities? Non-current liabilities in our statement of financial position. In that case, we have 10% loan notes. Can you see the 10% loan notes, which are dated 2025? The loan notes which are dated 2025. I hope you can see that under the non-current liabilities. Can you see this? Can you see this? Please confirm whether you can see this in the statement of financial position? 10% loan notes. Yes. Now, the 10% loan notes, we are given two balances. We are given two balances. We're given the loan notes for 2021 and basically 2022. So remember the current year added this date. So meaning that anytime you come across a question for cash flow, the examiner will give you statement of financial position for 2 years. Statement of financial position for the current year and the previous year. Now, the balances which are given here, these ones we treat them as opening balances during the current year, and these ones are the closing balances. It basically means that the loan note, 10% loan notes at the start of the year at the non-current liabilities, they had a value of 5250, and basically at the end of the year, they had a value of 8250. What that means is that these 10% loan notes, they increased from this to this. So how much is the increase? How much is the increase? The increase in this case is basically equal to 30,000. So these 30,000 are the loan notes which were issued by the company during the current